Well, in the thick of earnings and plenty happening in Jana Small Finance Bank, that's why we've picked that one for All About Your Company today. Trying to decode this, this was incorporated in 2006 as Janalakshmi Financial Services. It was an NBFC which converted to a small finance bank in 2018. Thereafter, of course, continuing its journey as a small finance bank and applying for the universal banking license just about recently, last year. What it does is housing, microloans, small business lending. The current market cap is around 5,300 crore. Jana Holdings currently holds or used to hold 22%, now holds around 17%, just sub 17%, and has guided that it will come down to 10% in terms of its holding. So the promoter stake will actually come down. But you have certain other interested parties also coming in. We'll talk a little bit about that. But first off, on the products and on the business itself. So the kinds of loans it does: affordable housing, MSME, term loans to NBFCs, vehicle loans across the board. You'll also see short tenor gold loans. In the unsecured space, it's microfinance loans, which they have done, which has bothered them over the last maybe 6 quarters or thereabouts. Also, there's loans against FD. They do insurance distribution as well, which contributes to fee income. You've got mutual fund distribution, which also contributes to fee income. And then they have a demat tie-up with Axis Securities. In terms of geography, they are present in 23 states and 2 union territories. The top 3 states, Tamil Nadu, Karnataka and Maharashtra, contribute for about 35% of both the loans, which is the advances, as well as the deposits. That's something you want to kind of keep in mind. Concentration to these 3 states is high. Then you have Gujarat, MP, Rajasthan, UP, where the concentration is 31%. And therefore, combined concentration of the top 7 states is around 66 odd percent. That's broad brush, the tilt in which the book currently resides. You're looking at outlets, around 826 is what they have currently in terms of branches. Their customer count has gone up sharply this quarter. 47 lakh customers is what they have. The book mix is 73% tilted towards secured and around 27% is unsecured, which has been the bother. Retail deposits is approximately 65% of the total deposits. Let's quickly start looking at the financials. And in terms of the growth, last 3 years or so, it's grown the net interest income number by around 16%, operating profit by around 5%, and net profit by about 8%. Largely, the profitability has been weighed down by higher OPEX. And the second piece is also the profitability has been weighed down by the provisioning which they've done. And you'll see the provisioning numbers as they come out in front of you. 744 crore in FY23. It's largely been flat and quite elevated at around 839 crore FY26. This is expected to come down sharply in the current financial year. So that's something we will continue to monitor. And as part of that monitoring, let's quickly also pull up what the metrics for Q1 FY27 were in terms of the P&L, because the results just came in yesterday. So essentially in Q1, what they've said is a 33% growth is what they've done on the net interest income numbers. Some bit of margin expansion plus balance sheet growth is what they've seen. Operating profit also fairly healthy in terms of the growth. 15% growth on the operating profit metric is what we've seen. We've seen provisions and contingencies fall by around 5%. Again, YOY is what we're looking at. So it's coming off on the higher asset base, which is positive on the credit cost element. And what you'll see is a sharp growth, 50% growth on the bottom line as a result of that. Can this clip continue? We'll quiz management on that, of course. Let's look at some of the other metrics. And in terms of the balance sheet, you're seeing 22% 3-year growth on the balance sheet number. We'll come to operating metrics in just a bit. Balance sheet, there you go. You've seen a strong growth on the balance sheet. Let's pull up the 3-year data, please, first off, before we look at this. And the YOY numbers, it's around 26% growth on the advances front. If we can look at the 3-year data on the balance sheet, there you go. You're seeing that data, around 22% growth is what we've seen on the balance sheet over the last 3 years. So the growth has been fairly healthy on the balance sheet count. Deposit growth has been quicker at 30%. Of course, has been choppy, but quicker. What we've also seen is a decent growth on CASA, 25% growth. And the CASA ratio, though, is slightly on the weaker side. We're seeing a CASA ratio sub 18% currently. In FY23, it was at 20+%. So we've seen a bit of a taper down on CASA, but that has been structurally also a difficult product from an industry perspective. Capital adequacy is fairly healthy at around 19.5% tier 1. and capital adequacy ratio looks quite good in that sense. Let's look at now the Q1 FY27 numbers. When we're looking at that, you're seeing a 26% growth on the advances front. The guidance is around 20 to 25 odd. Deposit growth is 22% growth on a YOY basis, and the CASA growth has been very strong this time around. So you've seen some good CASA growth. In terms of segments which have seen the best growth, we've seen gold loans nearly more than double of a very low base. We've seen vehicle loans grow at 78% YOY. Affordable housing, MSME, secured and unsecured. Unsecured has been lower in terms of the growth, but the other three have been largely in line with the growth that Jana Small Finance Bank has clocked. Those YOY numbers need repairing, of course. 26% growth on advances and deposits also. The growth has been strong, 20% plus. Let's quickly look at the operational metrics now. In terms of how the yields have shaped up over the last 3 to 4 years, we've seen a very decent shape up in terms of the yields, but they've fallen. And that's largely also because they're moving away from the unsecured segment towards the secured segment. So yield on advance is currently at 16.1% FY26. It's inched upwards by 30 basis points for Q1 FY27. It stands at 16.4%. Cost of funds at around 7.7%. Again, this determining factor of this will be the universal banking license. If that were to come through, you'll see a fall in cost of funds. That's typically how we see lenders operate. But you'll see a fairly stable kind of a range where cost of funds is concerned as well. Cost of funds from 7.7% FY26 has fallen to 7.4% Q1 FY27. Net interest margin has therefore improved, and you'll see that. But that's Q1 FY27. FY26 was a tough year. You saw that compression. So what you're seeing is on the top line, there has been a compression in FY26. We're off that bad cycle. And that's on the top line. On provisioning as well, you're seeing a compression. We spoke about that on the credit cost side. And that'll come up again. What you're seeing, therefore, is that this is starting to expand. Your NIM now is at 7.5% Q1 FY27. Cost to income ratio, when we're looking at the larger numbers, it has ranged in the 60s, in the mid 60s-ish. Of course, there have been times when it's fallen to below 60, but it's come back to the mid 60s of late. And what thereafter we've seen in Q1 is cost to income remaining at around 67%. So no change here on this metric. When you're looking at the ROAs which had compressed all the way through FY26 it compressed to 0.8%, are expected to rebound in FY27, and that's exactly how it's played out. At least for the moment, it's 1.4% in Q1 FY27. Monitor that closely, because as those ROAs expand, you will see the cycle unwind on Jana Small Finance Bank. That's what we're trying to track. GNPA and NPA ratios, they were elevated in recent years, but we're seeing it on a falling trajectory now. 2.33 currently, 2.24 in Q1 FY27 on the GNPA, on the NNPA at 0.9%. And if they were to go through with that universal banking license, they will have to keep it below 3%, the GNPA ratio, and below 1%, the NNPA ratio. And that's on asset quality. Let's talk about the return ratios. The return ratios have been subpar for Jana Small Finance Bank. It's been choppy, but otherwise, in most of the years, it's been subpar. You look at 3 out of the last 5 years, it's been below the 15% range, which is why we've given this a thumbs down. But it's cyclical. That's what it's indicating. Are we at the bottom of the cycle and are we bouncing back is really the question. How do we avoid cyclicality is what we will ask the Managing Director and CEO. Let's talk about shareholding pattern. And promoter ownership was 22% at the end of FY26. Now fallen to sub 17. I spoke about that. Expected to fall to sub 10. That's why we are neutral on this. But then we have TVS Group looking to invest and looking to up their investment. They've applied for RBI approval. If that approval were to come through, you could see a 10% or 9.99% holding of TVS Group in this bank, which obviously will be interesting as to how, therefore, and thereafter the bank evolves. Let's look at the analyst view. 3 buy calls, 1 hold call, and you've got an 11% upside, and therefore we're neutral on this one as well. Not looking exorbitantly expensive or cheap. When you're looking at valuations, it trades at 1.2 times book. Typically, when you're looking at the market cap, 5,300 crore. When you're looking at the balance sheet, 4,500 crore. And what you're therefore seeing is 1.2 times book. But if you could double profitability, or if profitability could jump by to around 600 crore annualized this year, which is what Q1 numbers seem to be indicating, you could well see this re-rate, because it would mean that it'll come to nearly one time 1 year forward book, which makes it look very interesting. That's where really the game will likely be from a valuation standpoint. It trades in the range of 0.8 to 2 times the last 2 year range for the bank. Let me bring on board Mr. Ajay Kanwal, who is the Managing Director and CEO at Jana Small Finance Bank, joining us. Ajay, great having you. You've been at the helm, Ajay, for 8 years now. We've seen all the cycles that we've gone through. Talk to us about how confident you are that we are now recovering, and that recovery is sustainable despite all of the headwinds, global as well as domestic, on the weather front.
Uh, Very good afternoon, Harsh, and to
Very
all
good
the
afternoon.
viewers. And let me compliment you, Harsh. I've been watching the analysis of Jana Bank, which you've been showing on the screen. Probably the best I have seen across most of the medias that I have been interacting. So well done. How confident are we? See, listen, let's understand Jana from a very basic perspective. What have we been doing in the last 8 years? We've converted nearly 100% unsecured business to a 73% secured business. So that does take investment, takes capital allocation, takes resource allocation, and also management attention. But here we are, as we speak, 73% of our business is secured, and that is where the volatility of NPAs or slippages or delinquency is much, much lower, which was the intention from day one, to make the bank 80% secured. The second piece, not in our plans, but we introduced that in November 2024, is saying while we want to be 20% unsecured, which is largely our core business MFI, which institution has been doing since 2008, we would like to put that under a guarantee program. So we have announced in the quarter one results that now we have reached 79.8% of all our unsecured business is under the guarantee program. So we put a floor to what losses or other credit losses the bank can take in any down cycle, I mean, any event risk. So if you think about the bank, Harsh, it's very basic. We are 73 odd percent secured. The balance unsecured business is put under a guarantee program. How confident are we? The book is very solid now because the real stress in the last, I would say, which ended in December 25. So 2 years, it's about, let's say, 7 quarter stress was essentially MFI stress. It's behind us in December 25. It is seen in the quarter four numbers. We did a 140 crore PAT in quarter four last year. Quarter one, as we all know, is a bit of a not a great quarter because delinquency kind of goes up a bit and volumes are lower. But our quarter one credit cost is identical to quarter four of last year, which is normally the best quarter. And that gives us immense confidence that credit cost is now a question behind us. So I do think that we are very confident of delivering the 80% growth in profit after tax that we have committed in our guidance.
And then the 2 odd percent credit cost guidance, that lever changes completely for you, Ajay, this year. Therefore, will it be, say, 1.6, 1.8? Will it be in that range?
Harsh, if you take 0.45 into 4 times, we are in that range.
Yes.
If you Because see, the first quarter, the slippages are lower, right? They've declined in quarter four. They further declined in quarter one this year. So slippages are declining. So there should be no reason why credit cost should go up. We got a slightly weak recoveries from our NPAs in Q1 because the entire force was focused on making sure that the slippages are low. Once we hold the slippage, then recovering back, we can always focus on that next. So I think we'll get better recoveries in Q2 for sure. The other piece are very important and has never happened before, but is that we are the asset book, which is unsecured, we're putting under the guarantee program of CGMFU. We can make the claim first time now, which we'll make in quarter three, because there is a particular, the year you guarantee and which it turns NP. And when you can claim, if you follow that cycle, the cycle starts for us this year from quarter three. And roughly we can claim about 60 to 65 crores. Now, if that goes right, which means we are able to do all the paperwork and the rest of it properly and it works perfectly, then I think we're talking of another different answer in terms of credit cost. But the very important thing about our bank is it is 73% secured and 80% of unsecured is under guarantee program. And that is fortunately the cycle of MFIs anyway turned. So guarantee program is there for the past recoveries. The current collection cycle is at 99%, and it's true for I think most of the people in the MFI industry too.
Yeah, I mean, just to kind of underline that, 65 crore, if you get that reversal in place, that'll be roughly, maybe 15 to 18 times, 18% of your last year's PAT, which is large, right, for you. Give us a sense, therefore. The credit cost guidance then, Ajay, should come down substantially. Would you go out and guide that?
I wouldn't guide it. I would let the money come first, Harsh. But I will talk about it because I think that's a fact. Whether we see, like I said, will first claim, it may take time, it may not take. I don't know, but I would like to put it on the table. Second, I wouldn't worry about last year's PAT. See, last year we went through cleaning out the MFI stress. Our first quarter PAT is 155 crores. If you just multiply that by 4, we are in the range of hitting our, or rather crossing our guided PAT of 80% over last year. So we did 333 last year, 80% higher is 600. We're at 155 in Q1. So I'm not very anxious about how we see the next few quarters because 2-3 things have become very significant. See, first is when the MFI stress started, we over-invested in secured, which is why you see the cost income elevated. In March 24, the cost income was 57. We are now sitting at 67. It is not because we've doubled people's salaries, it's because we've invested in our businesses. Now we're going to see the return. So you will see cost income declining. Operating leverage will play in, and that will be very visible.
Before I ask you on operating leverage, Ajay, and it's very interesting, I want to know how much that will decline by, but more importantly on growth, right? That really is the key signal for me. When growth comes back in a sharper fashion, it means that there is confidence for the lender to grow. You've grown 25% plus now. Would the full year likely sustain 25% plus?
So look at so we are serving the underserved, right? So affordable housing, is there enough business there? I think there is tremendous business there. MSME is an ocean. I can grow as much as I like. It's just that we have to choose the credit and the place where we have a competitive moat. I don't see a problem in growing MSME. I think it'll be our fastest growing business this year would be MSME. Gold loans. We have 826 branches. Gold loans is only present in 20. I can easily add another 100 branches. So gold will grow. Two-wheelers. We are in, if you take our housing and micro-lab business, we are in 240 cities. Our two-wheelers only reach 150 cities. There are 90 more cities where we are present, where we have not done two-wheeler business. So there is enough room to grow. Used cars. We are in 50 cities, 50. We can go to 240 cities. There is enough room to grow. I wouldn't even for a second worry about 20% asset growth. If you see the first quarter, our NBFC lending is at negative growth rate because we are very confident of our own asset growth. See, the only thing that we have to manage are 2 things right. Because we are in the right segments and we have already done the hard work of building our businesses, we have to make sure our portfolio quality remains solid. So our collection focus, making sure we're not bringing marginal customers, I think that becomes the most important piece. Second is getting operating leverage, because that will give confidence to everyone that we're using our money well.
I'm itching to ask you operating leverage, but I'll quickly complete the growth point. Loan to deposit, elevated, would you be worried or would you not?
As a banker, you always have to be worried. I never stop worrying, I can assure you that much. But listen, 2-3 things. One is, see, We have three lines of business, which is affordable housing, refinanced by NHB. We have MSC, refinanced by SIDBI. And we have agri loans, which are refinanced by NABARD. I have roughly about 4,500 crores on my balance sheet, which is visible in my presentation, which is from the three refinance institutions. The combined cost is 7.7% from these institutions, but the range of lending, which is the tenor of that loan, is roughly about 6 to 6.3 years on an average, weighted average. So it is the best loan for me to take because it gives me that ALM matching. Because as I'm getting secured in longer term, I need longer term liabilities and the best liabilities from three refinance. So I tend to have term loans. If I really drop my CD ratio quite a lot, I will be sitting on surplus cash and carry costs. So I try to manage it around the early 90s. For us, if you have noticed, we've never had a deposit growth as a problem ever. We have the right deposit rates, we have the branches, we have 3,000 people, we have a fantastic mobile bank, which is 4.5% on the Google Store, etc. So I don't see, yes, my quarter one should not have been 97. I would prefer to be in the 92, 93 range. We will make sure we bring it to that. Nothing to worry. But yes, quarter one was a bit flattish on deposits. It wasn't the original plan, but it ended up being like that.
I like the confidence there. I also want to quickly quiz you with regard to, therefore, margins. Your margins have come in at 7.5 this time around. Sustainable? Can you get better than this? In case of a universal banking license, which you've likely reapplied for, what's the timeline? And if so, what will be the immediate trigger with regard to where will the margin number therefore lie?
So I think we should separate the two. Universal Bank, if and when we apply, will not change margins in a hurry because by the time we get approvals, we execute and we come out on the other end. That'll be some time away. None of our numbers of PAT or growth or even liability side growth has nothing baked in of Universal Bank. If that happens, that'll be all a top up or everything will be additional. So I think Universal Bank should not be at least from a 2-year range, be in our story at all in terms of how it impacts the performance. Now on NIM, I think the NIM will kind of be flat at 9 and 7.5. And I'll tell you why I think so. March 24, when cost income was 57, unsecured book was 60%, our NIM was 7.8. Today, our MFI book, which is the unsecured book, has just reached, is at 26 odd percent. I don't see it growing very fast. That was the one where NIM had dropped from 7.8 down to 6.3, it's come back to 7.5. My sense is remain 7.5. Cost of funds have dropped 50 basis points over last year. I don't see cost of funds coming down anymore. I think the rates have hardened now in the deposit side. So yeah, 7.5 would be a fair estimation of NIM. I think the other piece, Harsh, which I know you wanted to talk about operating leverage, so I will give you one piece of information which is very important from a Q1 perspective. Our cost growth from Q4 last year to Q1 was just about 1.6%. Basically signaling that we have enough headcount, branch presence, hardware to make sure we deliver the 20% asset growth without really going for a cost jump.
Ajay, if I were to just kind of combine all of this into one, right? 80 basis points of margin lever is what you'll use this year versus last year. 100 basis points of credit cost lever is what you'll use this year versus last year. That improves or takes your ROA, that alone takes your ROA to above 2.2% this year if all things go as per what you've said, which likely seems to be the case, excluding OPEX. Is that the right way to think of Jana from an FY27 standpoint?
So, Harsh, in my head, my last year's, at least because everybody has a slightly different way of calculating, my credit cost was about 2.3, 2.4%. I think the 1.7, 1.8 range this year would be a fair estimate. The NIM going up is absolutely true. I think that is going to sustain. 6.3 was the lowest point. So average would be about 6.6, 6.7. So let's say I've got 70, 80 bips out of that too. And that will be sustainable. That is sustainable. Credit cost is sustainable. Costs were very clear about in our heads that we are not going to let it grow. So yes, I don't know whether we reach 2.2, but I certainly think ROAs would be in probably 1.6, 1.8 range. That is what I last kind of did a back of the envelope saying if everything happens well, that's what we should look at.
Got it, Ajay. Being conservative. Ajay, last piece on shareholding. I obviously can't tell you to comment with regard to what your promoters will do. But any thoughts from an investor standpoint on the shareholding? Because there's just so much debate. 17% falling to 10, and then you've got TVS in the mix. And just give us a sense. Any message for investors?
So first, our promoters are fabulous people. And I say that because being here 8 years and having been through a COVID and a further microfinance stress, etc., they've stood by us and given us capital whenever we needed. So I will always hold them in very high regard and respect. But for the last 4 years, since the bank has started doing well and we, got variety of other opportunities to raise capital, our promoter has not put any capital in the bank. And to be honest, we were very happy diversifying our investor base also. So that's the first fact, which is our promoter has done a terrific job. Thank you. We must thank them. We'll always remember them. Without them, the bank wouldn't have been around. But last 4 years, we've not needed them for capital. They were at 44% at the peak level. They're down to a 16.85. They have publicly said they need 6 more months to sell. And
Correct.
But one very important thing, Harsh, they only sold the first 4.99, which is when 22 became 16.8, whatever. They sold it to a strategic investor whom they thought will be very good for the bank from the longer term. So they're very thoughtful of what they're doing. They haven't sold in the market. They've asked time to sell. They could have easily sold in the market also. They've not done that. They obviously expect the bank to do well. So yes, I've spoken enough to tell you that we're very responsible holding company, which has really done well for us.
Point taken. Thank you so much, Ajay, for coming in and speaking to us. That's a very confident-looking Ajay Kanwal on the back of the numbers of Jana Small Finance Bank. Completely timed out on this edition of All About Your Company. Thanks so much for tuning in.